2022 was a weak year for Google as the stock fell over 30%, which has put them at a market cap of $1.3 trillion and a PE of 21. But since the start of 2023, we have seen an 18% rally in that stock price. And now they've just reported their Q4 earnings. So now it's time to make an analysis to see if us value investors can figure out whether Google is a buy or a sell at these levels. So make sure to stick around to the end of the video as we'll answer all your questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we will go through the fundamentals of this business. We'll create an analysis. We'll project on the trajectory of this business, and then we'll use our calculator to see which buying points, if any, are present with Google stock. And if you do enjoy this video, make sure to like the video, subscribe. It really helps out the channel. Also, make sure to comment your thoughts in the comment section below. And without further ado, let's jump into the video. All right, we're looking at Q4 earnings for Alphabet stock here. And well, what did we see when it comes to the earnings release? Well, they missed on analyst expectations by just about 14 cents. I know 14 cents doesn't seem like a lot, but when you're looking at an earnings per share figure of $1.05, 14 extra cents that they were expecting to make actually does make quite a difference. So it's decently below what analysts were expecting. In terms of revenues, those came in at $75 billion, just a 1% increase on a year-over-year basis. Also missed analysts' expectations by about $500 million there, relatively in line with what they were expecting for, revenues of 76 billion or so. On a quarter-over-quarter basis, we definitely saw some improvements across the board, but we want to look at this from a year-over-year perspective to get a bit of a longer-term picture here. So if we look at our consolidated statement of income, we can see again here for 2021, we had $257 billion worth of revenues. Now we have $282 billion worth of revenues. So revenues definitely increased on a year-over-year basis, despite that 30% decline in the stock for 2022, which is definitely something that alerts us value investors that something may be going on here behind the scenes where we may be able to come in here and pick up an undervalued stock. Now, that being said, we still have to look at our expenses. So expenses, as you can see, cost of revenues have ticked up, research and development, a sizable increase there, sales, marketing, SG&A, etc. By the end of the year, they had $208 billion worth of expenses on those $282 billion worth of revenues, of course, leaving them with income from operations of $75 billion worth. Now, this is a decline on a year-over-year basis, of course, as a result of the expansion in their costs to produce those revenues. And if we want to break this down a little further and see what exactly is slowing this business down, well, we can look at the financial statements provided here, right, with the breakdown of their segment revenue. As you can see, at least for this quarter, we saw declines across their Google advertising business here on a year-over-year perspective, making out a total of $61 billion last year, now $59 billion, so a $2 billion hit there. But once you add in Google Other, they had total revenues here for Google services of $67 billion. Again, still a $1 billion hit or so from last year's results. Now, what we did see an improvement on at least was Google Cloud, okay? And this is always great to see because typically with Google Cloud, these customers have long-term retentions and they lock in with these pricing plans that generates recurring revenue on a consistent basis. So that is good. And so once we add in everything else here, we're left with $76 billion for this year, again, on that $75 billion last year from a revenue perspective. That being said, when you look at this from an operating perspective, last year, Google services came in at $26 billion. This year, only $21 billion, for this quarter here. Google Cloud on a year-over-year basis for this quarter, at least, not profitable, and neither are there other segments here. It left them with only $18 billion worth of operating income on that $21 billion last year. Now, something that you will look to see over the next few months, and something you should be looking out for, especially with Google and Alphabet here, is their investments into AI. It looks like they're going to make a $300 million investment in a startup called Anthropic. Of course, that's kind of the next wave for these big tech companies, is to get AI integrated into their business models. And so we'll have to see over the next few years how they can incorporate that into their fundamentals and what improvement or impact it will have on that business. But if we look at this chart here from Main Street Financial Data, the first link in the description and a great investment resource, we can see how this business has transformed over the last few years. They've had strong growth, up until Q4 of 2021. But as you can see, for this full year of 2022, we actually had a period of stagnation there for about 3 quarters. And this last quarter there, we did actually see some growth finally. But typically over the last few years, you have seen this business growing. Now, we did have a little bit of slowdown back in 2020. Obviously, at this point, we had lockdowns, tons of Forex impacts, things like that. But other than that, we've seen the trajectory of this business continuously progress higher and higher, at least in terms of the fundamentals there. So, 2022 was a bit of a challenge. We're going to want to see how 2023 plays out. Can they continue that momentum of growth, or are we going to start to enter into a period of more stagnation? That's going to be interesting to see over the next few quarters. If we look at this chart here, though, we look at their expenses. You can see, obviously, they have been increasing their expenses on their research and development quarter over quarter over quarter. Same thing with their sales and marketing. So that obviously translates over over to their general and admin as well. And so, as we always say, when we see that increase to their expenses, a stagnation to a degree on their revenues, we're going to see, if we take a look at this chart here, their margins are going to be, hit to some degree at least. And as you can see over the last few quarters, since Q3 of 2021, actually, we've seen a decline on those margins down into a more stable 25%, at least from an operating perspective. Those are still healthy and not something that should really concern investors. But if they can clean up those expenses, we can see margin improvement. You'll see higher levels of fundamental resurgence there. And, obviously cutting costs is a focus of theirs, as they've just reduced their workforce by about 12,000 jobs, which is a huge layoff there. They are going to have some severance charges in the next few quarters or so, in excess of, $2 billion or so, so you can expect to see that on next quarter's results. They're also looking to optimize their global office space, and you're going to see probably about a $500 million impact on the fundamentals there as well. But I think in the long term, this will definitely clean up a lot of those expenses and should have margin improvement overall. Now, if we look at this from a liquidity standpoint here, massive amounts of cash sitting there on the balance sheet. As you can see, $140 billion worth last year. If we look at this year, they've been using a bit of that cash up. They only have about $113 billion worth of cash, but that's still a massive amount of cash. If we compare that to their debt figure, just $14 billion worth of debt. Super healthy position here. They have a ton of cash that they can do acquisitions with, make further investments with. They could easily pay out a dividend if they really wanted to, but obviously this business is focused on their growth. We're going to want to see how they can actually achieve those levels of growth in the future. And as you can see, when we look at this quarter's free cash flow results, $23 billion worth of cash from operating the business, spent about $7.5 billion of that to maintain, sustain, and grow the business for this quarter at least, leaves them with $16 billion worth of free cash flow. If we look at this from a full year perspective, they had about $91 billion worth in cash from operating the business, spent about $31 billion of that on sustaining and growing the business. And so let's say they had about $60 billion worth of free cash flows by the end of the year. Massive cash position there. What are they doing to reward shareholders with that though? Not a lot is being done here. Okay, as you can see, their main focus, they spent $60 billion worth on repurchasing shares. And so that's what investors can expect from Google, at least from a free cash flow perspective. Now, if we look at their operating income this year, they came in with about that $75 billion figure. And you can see the growth that this company has had over the last decade. And so if we jump over here to our calculator, and we expect that at the very least, they can produce at least $75 billion worth in operating income, for 2023 into 2024, etc. And we require a 10% return. Of course, they do not pay that dividend there. And we only require a 4% growth rate for Google over the next decade. Very conservative investments here. On a 20 PE like they're currently trading at, the stock should still be worth $150 here with a modest 4% growth rate into the future. Now, if the business can actually elaborate, we see a rebound in the economy. Of course, this business doesn't have much competition to deal with there, across majority of their segments, YouTube, search, etc. They can grow at about 12% into the next 5 years. Then that slows down at about 7% growth rate for the 5-10 years after that on an elevated 27 PE. The stock would be worth $332 per share. Again, this is still from a conservative standpoint there. This PE could elevate up to the mid 30s there, and you can see how that would also impact the stock price on that rebound in the economy. We see healthier interest rates, things like that. Now, in the very worst case scenario where the next 5 years we see a negative 1% slowdown in this stock and their fundamentals, then we see a resurgence in the 5 to 10 years after that, growing at about 5% per year on just an 18 PE. The stock would still be worth $110, still higher than where we are actually right now, for our very worst case scenario where the business is actually struggling quite hard to grow. Very unrealistic for a business like Google here. And this is really coming in at our margin of safety level. We're only trading at a 4.7 price to sales, a 5 price to book. When we take a look at this stock chart here, you can really see why the business is bouncing, 20% off those lows to start the year. And so overall, with everything we've discussed so far, I'm going to give Google or Alphabet here a 7.5 as an investment rating. We are bouncing off those lows there underneath $100 per share. This was an absolute steal in my point of view, but I think we're still trading underneath our margin of safety level here for this business. We've seen declines here that are kind of unwarranted at this current point in time, really just declines led by the market. And I like the growth prospect here that even if the business can't grow for the next 5 years and then they start to grow at just like 5% into the future, the business is still worth more than what it's currently trading at. Means that even though we have a $1.3 trillion market cap, we're not overvalued at these current points. But that's the analysis for today's video. If you did enjoy, make sure to like the video, subscribe, and don't forget to comment your thoughts in the comment section below. With all that, I'll catch you on the next one.